So from its highs, Alibaba's stock is currently down around 50% at the time of this recording, meaning that the Chinese Amazon, which arguably one of the largest kind of global competitors or threats to the giant reigning king of Amazon, this is a massive Chinese e-commerce company that is extremely profitable, brings in unbelievable amounts of revenue, and is still yet outgrowing and outpacing much of their kind of smaller, younger competitors out there. Unbelievable stock, unbelievable company, and yet it's lost half of its entire value in just the past year or so. So given the circumstances, okay, we know that China continues to put a ton of regulatory pressure on them, continues to drive the stock lower, keeps crashing it lower and lower. As someone who already owns Alibaba stock, should I continue to buy this stock as it crashes lower, or am I just catching a falling knife at this point, and should I consider selling out of my position altogether? Let's find out. What's up, everyone? My name is Ali. Welcome back to my world of stocks. All right, now we've got a few things to run through here, but let's just kind of keep it simple. Let's start by pulling up the stock chart. We'll discuss why the stock has been crashing, how long I kind of expect that to continue, and whether I should consider buying more, holding on to what I got, or maybe even start to sell. Well, taking a look at the past year, we can see that from their highs of around $320 a share, stock has now crashed by around 50%. And I gotta say, guys, this is definitely one of the smoothest kind of steady falling crashes out there throughout the past year. Of course, this is a much broader trend that is happening right now across many Chinese tech stocks as a result of Beijing stepping in and showing the world just how much power and control the Chinese Communist Party still holds over their economy. Notably, the CCP decided to check some of the biggest players like Alibaba and Tencent, as they are likely becoming too large and thus perhaps threatening the power and control of the government. At least that's the story coming out of major publications like Yahoo Finance and Bloomberg, just to name a few. I will, however, talk about the other side to all this, but just to further illustrate this point a little bit more, that check on growing tech influence even found its way to billionaire co-founder of Alibaba, Jack Ma, who was making critical claims of the CCP before he strangely disappeared for months, leading to all kinds of speculations, although he did briefly show back up, but has since been completely silent of any criticisms of the Chinese government. It didn't stop there though. The CCP went on to either fine or punish Alibaba several times, including a record-breaking fine in April worth almost $3 billion for anti-competitive practices, as well as the cancellation of the IPO of their financial arm called Ant Financial, which was set to be one of the largest IPOs in history, after which Alibaba released a public statement that sounded almost like like a captured prisoner being forced to comply. I mean, it sounded really strange, but they weirdly praised the Chinese government and their stricter regulatory pressure, stating Alibaba would not have achieved our growth without sound government regulation and service, and the critical oversight, tolerance, and support from all our constituencies have been crucial to our development. For this, we are full of gratitude and respect. Okay, so obviously that sounds a little weird. And look, believe me, I'm on the side that would never trust anything or believe anything coming from the CCP. But to be fair, there are some logical reasons why the tech giants of China should at least adhere to some basic regulations, as many of them were using their monopolistic size to make it almost impossible for smaller companies to compete. So for example, and again, let me just be very clear, I'm not in defense of the CCP. I think they do horrible things, but when hearing kind of that side of the story, at least they would argue that new regulations were needed because Alibaba, for example, was literally preventing merchants from selling their products on competitor online shopping platforms. And so if you're a merchant and you obviously want to be listed on Alibaba since it's the largest, platform out there, then you weren't being allowed to list anywhere else. And that made it so that Alibaba could basically own a monopoly over the market, which is obviously not fair. Now, the reasons why investors are getting so worried, though, is that they're just kind of now realizing that the CCP does mean business and they're willing to badly hurt companies and kind of crash their stocks if they have to. So, for example, Didi was considered to be like the Uber of China and other countries too. But when they decided to IPO in the New York Stock Exchange, despite the CCP telling them not to, the Chinese government stepped in and basically crashed the stock into the ground. Apparently, Didi had been warned by Chinese regulators to delay their IPO, but Didi went ahead with it anyway and achieved the largest Chinese IPO on the New York Stock Exchange since Alibaba in 2014, and as a result, China accused them of violating laws and regulations in collecting and using personal information from their customers, and as a result, they pulled the app down from Chinese app stores and barred them from registering new users. Again, you could probably argue back and forth on whether China actually cares about having a fair and honest market or if they're just trying to flex their muscles and regain control over these high growth companies, but either way, the result was that Didi stock crashed by 50% from their highs because smaller competitors were able to steal market share during the time that they were offline. And it didn't stop there. China also went after food delivery companies by forcing them to be more transparent on driver pay and meet minimum requirements. They went after online education companies by forcing them to go nonprofit so that poor students can have a smaller burden. And of course, they also went after internet companies by preventing them from blocking links to competitor companies. Again, a lot of these regulations make absolute sense on the surface, but sometimes they may go too far. I mean, when you literally force certain companies to go nonprofit, that's when you're probably overreaching there. And of course, you're going to spook investors into selling out broadly across Chinese stocks in general. In fact, one of the biggest reasons why Alibaba stock has been crashing isn't even company specific, but rather just because so many big Chinese ETFs hold it within their ETFs, which have also been crashing and thus hurting Alibaba as well. For example, the K-Web China Internet ETF, which holds both Tencent and Alibaba as its two largest stocks, has already lost more than half of all its value just in the past year. Anyway, it's anyone's guess how far this will all go. Maybe some of these regulations are fair and they were needed. Maybe now that China kind of put a foundation for some of them, maybe they'll start to ease off a little bit now, and then maybe investor confidence will start to return and these stocks will start to recover a bit. Or maybe all of this was just an excuse for the CCP to gain more control and more power over their economy and over these giant companies that are becoming really big and really influential. And maybe that will just continue to get worse and worse over time. For example, we know that Chinese government literally forces certain companies to have CCP members on their boards. I mean, maybe it's all just getting a little bit too shady, too sketchy, too risky, and maybe investors should start to sell out, especially considering the VIE structure that many of these companies use for their stocks, including Alibaba, by the way, which means you own a shell company. You don't even own the actual thing. So if China was to all of a sudden decide to crash more of these companies into the ground, well, you don't have very many rights as an investor. There's not a whole lot you can do about that. Personally, I think the most likely outcome will be somewhere in the middle. I do think China will try to have more control. It's just the nature of kind of a communist mentality. They're going to try to have more control over their economy, which will increase the risk for us foreign investors that have no real say in any of these matters. But at the same time, I think that risk will be limited more so to smaller companies rather than gigantic ones like Alibaba, who China, I would say, not only needs them to succeed, but I think it would also cause a pretty big uproar with some of those bigger companies if, China was to heavily destroy them and so many people would be invested in them and be so heavily impacted by them. But let me just kind of explain these last couple points a little bit further. I mean, when looking at shareholders, American investors currently hold over $1 trillion in Chinese stocks, and 86% of that is held by giant mutual funds and hedge funds. So Alibaba all of a sudden disappearing would be a gigantic deal because according to Bloomberg, over half of all the Alibaba ADR stock is actually held by US investors. I just don't see how you come back from that, some kind of massive move like that if you're China and you screw over that many rich people. Now, granted, it does look like a lot of these hedge funds have actually been selling out lately because of this risk. For example, Benzinga reports that Cathie Wood's ARK Invest cut her position to only 40 shares left and invested in some of their smaller rivals instead, thinking that the new regulations may help them better compete, while BlackRock, which is the world's largest asset management company, sold more than 74 million shares last quarter as well, which was likely a big reason for the stock crashing. Of course, there's other reports that both ARK and BlackRock have been buying some more Alibaba stock recently, so who knows what exactly is going on. I bet that there's definitely some manipulation here where they kind of crash it and then slowly buy back in without anyone really noticing so that they can get the recovery. In fact, that's exactly what these hedge funds seem to be predicting, because when you look at their statements, they now all of a sudden sound bullish on Chinese stocks. I mean, BlackRock, for example, they stated that China is no longer an emerging nation and investors should increase their exposure to it by buying more Chinese stocks. In fact, they recommended that investors increase their exposure by 3 times their amount. Also, also saying that there is little spillover risk from China's assertion of greater control, while Pictet Asset Management also chimed in, saying that a withdrawal from Chinese stocks is not warranted because the tighter grip of Chinese regulators is just a belated response to innovation and the breakneck growth those industries had in the absence of any regulatory framework. By the way, they're not wrong about that. I mean, this is a company that next fiscal year is expected to do over $1 trillion in revenue in Chinese yuan, which is like 155 billion US dollars, and they're still somehow managing to grow consistently at over 20% a year, which is unbelievable performance. And yet, because of all the pessimism, their forward price to earnings ratio is only less than 18. Do you have any idea how cheap this is? I mean, compare that to other giant tech companies and you'll find Amazon at 61, Microsoft at 34, Google at 31, Apple at 27, and then you got Alibaba at the very lowest, cheapest there at only less than 18, despite them typically seeing much higher growth than all of those. So yeah, it's a huge risk, and especially with the VIE structure and the idea that the CCP can step in at any time to kind of damage their growth. But I just think the risk is worth it at these prices, because I can't imagine China not needing companies like this to succeed. I mean, when you look at how much China wants to compete with the US on a global scale, I just think they really need companies like Baidu to compete with Google, Alibaba to compete with Amazon, Tencent to compete with social media and gaming, and of course, all of these are huge plays on artificial intelligence as well, autonomous driving, cloud computing. These are all markets that China desperately wants to dominate. So you add it all up and you try to come up with some kind of overall picture on what's going on here. And if you ask me to take kind of a guess on it or my opinion on what's going on, well, I think you've got this communist government that is obviously going to want more control, so they're going to implement more regulations. Some of those regulations might be fair, some might not be. That's up to you to decide. But it happened and it's happening, and I think some giant hedge funds saw that as an opportunity to sell out and crash some really good value stocks like Alibaba, Tencent, Baidu, and so on. And I think they're going to slowly start to buy back into them, because I think that's what hedge funds do, and I think they manipulate the market, and I think we're seeing at least a little bit of that. And so I think these stocks will recover over time, and I think this will ultimately have been probably one of the best buying opportunities for some really good value Chinese stocks. Or I could be completely wrong, and this could all be a horrible mistake to buy into any of these stocks, and anyone invested in them could lose all of their money. Personally, I think that the former is more likely, and so I will continue to buy into these stocks myself, but you should understand that there is a lot of risk here. Anyway, to minimize that risk, at least for myself, I follow 2 basic rules when it comes to Chinese stocks, and this will continue to be implemented going forward. Number 1 is that all of the Chinese stocks that I own altogether as a whole cannot make up more than 10% of my portfolio. It's just a rule I've got right now, and it's one that I like because it limits the influence it has over my portfolio. If I was to literally lose all the money I have invested in like Alibaba, Tencent, Baidu, it's not going to just, completely destroy my portfolio. It'll be a hit. It'll be a significant hit if that's the worst case scenario, but it won't destroy me. So that's one thing. 10% or less, so kind of a single digit percentage, I think is reasonable for Chinese stocks. Still gives you good exposure to it, but limits that exposure a reasonable amount. And then number two, I only buy with money I don't need, and that's a given, and that's kind of a given for all stocks just in general, but this is especially the case when it comes to riskier Chinese stocks. So not investing with savings money, retirement money, emergency funds, rent money, none of that. This is money that I can absolutely afford to lose. And as long as I follow those two basic rules when it comes to buying stocks like Alibaba at these prices, I will continue to do so. So anyway, those are my opinions. Those are my thoughts. I hope you guys enjoyed the video. I'd love to hear your thoughts down below. Make sure you leave a comment down there. Hope you enjoyed the video. Hope I was unbiased. And if that's the case and you appreciated that, then maybe consider hitting that like button, because it really does help the channel and it supports me a lot. But anyway, thank you guys for stopping by. I will catch you in the next one. Take care. Bye-bye.